And what are the implications of the dollar peaking for Asian equity markets at this point?
Good morning, Sherry. Obviously, the dollar has been a bit of a headwind both to US earnings and thinking about the outlook for Asia markets. It's one of the risk factors when we look at what's happening around Asia in a relatively positive light. And we're very much at the focus as you had those financial conditions tighten. Historically, that has been something that's weighed on the outlook. However, we do balance that off with thinking about the Asian recovery that is still going through, the domestic demand that's coming through from some ASEAN countries, and the fact that China is going through that sort of staggered reopening, even if there are some, again, risks there, but it should be quite supportive for the region more broadly. So I think that in this scenario, we see that the dollar headwind being a little bit more tempered in terms of what it means for Asian equity performance. And as we see the Fed, I think, have a bit more of a pause, not necessarily a pause, but we see the Fed think more around that policy trade-off between growth and inflation. We may see the market start to think about exactly where rates are heading, and maybe that we've already sort of priced in the peak for interest rates for the Fed.
Yeah, I was going to say, how much of the Fed's moves have Asian markets already priced in? Not to mention, perhaps, this week, as important, those huge tech earnings and what it tells us about the broader global economy as well.
Yeah, the earnings season in the US has been a case of not terrible, but not great. It's been quite a mixed bag. And I think that the clear messages coming through, again, that dollar headwind being very much there, given those offshore revenues for some of those tech companies. But also the fact that you've seen that on the consumer side, clear messages around the slowing demand coming through from some of those big retail names, and also the more persistent demand they see for some of those secular trends around AI, cloud computing, and some of the tech stocks. And I think that feeds back into this narrative around that rotation that's been persistent trying to move into value, but may start to move back towards some of those growth sectors. For us, it is about the valuations when it comes to the US market. Those valuations have come down, but not nearly as much as other parts of the world. So you are still paying a little bit more than you perhaps should for those earnings. And so we do watch that closely in terms of thinking about, is there more of a derating to come in the US market before we actually see something more sustained in terms of an upward move in the equity market.
Kerry, talking about this kind of reset when it comes to tech, take a look at this chart which looks at the New York FANG Plus cohort. And in fact, we've seen coming down from that 2021 peak, they've actually erased most of that group's overall outperformance on a total return basis. So is there a little bit of a psychological reset in terms of how we frame the way that tech stocks trade? Because there is a sense that they're going to have to really outperform to be able to convince the consumer and the investor that they're, indispensable in such a challenging environment.
Yeah, I mean, you just look at that chart, it just shows you at the start of the year, these things were so highly valued and highly prized in a world where there was so much liquidity that, the valuations had gone up such an extreme that, of course, when that narrative started changing, these, felt the greatest pressure from that derating. And again, it comes back to that point around, can those valuations fall further from here? I mean, for us, it's a bit of a trade-off between thinking about the near-term pressures and those longer-term secular trends that we do see in some technology stocks. Again, I would start to try and think of breaking that apart in terms of the hardware versus software for some of those company names, what you're seeing in terms of profitable companies versus non-profitable companies. And really, I think the market will start looking at the earnings potential for these companies over the next, not just this year, but the next 3, 4, 5 years, and thinking about where they're more attractively priced in this environment. The here and now, though, I think is really around general risk sentiment and where the market is trying to find that bottom. And again, I think it's a bit early to say that we've reached the bottom in equities just because we've had a small bear market rally, and that there's not going to be more downward pressure from the sort of negative sentiment towards a recession and the negative sentiment that comes from just thinking about a move back into fixed income and away from equities.
What's your assessment when it comes to Chinese equities? Because we have the big news, obviously, of Alibaba pursuing that primary listing in Hong Kong, kind of reshifting its focus back to this part of the world and the mainland market. Does that give a bit more impetus for market sentiment, or do really the macro factors still create a lot of uncertainty?
Yeah, there's a few uncertain factors when it comes to China. Obviously, they're still trying to deal with the reopening from COVID. It's not exactly clear how lenient they'll be or how much flexibility they will have into further restrictions. And I think that's a very important signal in terms of, other business investment or consumption from consumers, or whether they'll actually start to retrench a little bit if they think there's going to be further lockdowns. For us, the signs of that flexibility coming through, the fact that you still have very much a strong investment-led and infrastructure-led growth story in the second half of the year, year, and you are seeing that rebound come through. And again, a government that's trying to address some of those issues in the property sector does set up quite a positive case for thinking about growth out of China at the economic level for the rest of this year. And also some of those regulatory changes that we've seen come through. Last year was a bit of a shock when it happened to that. This year, you're getting a more clear idea about implementation and clarity of what that actually means. I think that's what's being reflected in some of the earnings outlook for tech companies there, as well as thinking about that shift in delisting. I think it's a case of trying to figure out how to operate in the jurisdiction that you're actually based in, and thinking about the fact that you want to have access to global capital and what's the best way to do that. So you might actually move into a world where you see more of a dual listing scenario, companies making sure they have access to all that capital and that cost of capital isn't rising too significantly.